Hello, welcome back. This is Si Wing Yi from the Yi Real Estate Network. I believe this is my fourth or fifth real estate housing forecast for 2023. And I did what did I do this past week? I did the Core Logic 2023 housing forecast. Then I just did Zillow 2023 housing forecast, the video, and which you will see it this week. And let me see who else. I forgot I did so many. Anyway, today I'm doing Redfin 2023 housing forecast. So let me share my screen and let's get it started. There may be more throughout this December because there are many popular media outlets and websites are starting to do their 2023 housing predictions. So, as always, I will always will give you my take toward the end of each video. So, based on my 30 years of real estate investing experience, I do have something to say. If I need to refute some of those forecasts or some of the so-called experts' opinions, I will do so, and I will do it very bluntly because I've been through the up cycle, down cycle, sideways real estate cycle, whatever the case is, and over the past almost 30 years on my personal portfolio, as well as I've helped thousands of mom and pop real estate investors to buy cash flow, low cost, entry level properties in the best prudent market in the country and to achieve wealth. Cash flow properties, okay, low cost, entry level with good rent to value ratio. But I'm not here to talk about investments. You can always log into my website and become a free member. You can learn accordingly. But today I'm going to talk about Redfin's annual housing outlook. A post-pandemic sales slump will push home prices down for the first time in a decade. It was published today, December 6, 2022, by Taylor Marr, a Redfin economist. So without further ado, let's get us started. Very interesting, as always. So Redfin says, we expect home sales to sink to their lowest level in more than a decade in 2023, as high mortgage rates keep housing costs up and prevent people from moving. High homeowner equity and a resilient job market will stave off a wave of foreclosures. All right, so let's get us started. Mortgage rates will take center stage in 2023. Yes, of course, it has already taken center stage in 2022 as we speak. So it's all about the Federal Reserve and their ways of destroying the housing market and potentially the economy. It's just mind-boggling how much they are screwing up. Mortgage rate, with the highest rates likely to make its slowest housing market since 2011, which is right after the housing crash of 2008. So, yeah, the slowest housing market moving forward next year in the past 15 or so years since the crash. All right, so there are, I believe, 11 total predictions. So let's go over one by one. Some of them I will spend more time to discuss some prediction. Some are the numeric predictions below. I'm not going to spend as much time. So if you see the yellow highlight, you will see we can talk about that. But prediction number one is home sales will fall to their lowest level since 2011, with a slow recovery in the second half of the year. Redfin expects 16% fewer existing home sales in 2023 than 2022, and people will only move if they need to. We'll talk more about that. So home sales are likely to fall to the lowest rate in 11 years. The potential downside, as you can see, it could fall quite a bit. If this is the baseline and this is the upside, we'll talk more about that. There are three metrics they want to show on this graph on several categories. So let's discuss that. So, so they, as a result, there will be a 30% decline from 2021 in terms of home sales, and it's also it will lead to the lowest housing turnover rate since 1980s. Wow, with just 32 out of every 1,000 households selling their home in 2023. So that means most homeowners have this lock-in effect. They have it just amazing low mortgage rate of less than 4 to 3%. They are not going to move a needle. They will stay put and take advantage of their amazing mortgage, 30-year fixed rate mortgage at historic lows. So they have no incentive to sell. So you're not going to see homeowners putting their house in the market, most of them that is, until certain things happens. We'll may talk about that toward later on in this video. So existing home sales will likely fall 31% year over year in the first quarter of 2023. And couple that with builders are having 20% fewer sales of newly construction homes. So you know what that means. Builders are not building enough homes. They're having a pullback because of a lack of demand, and homeowners are not selling because why should they sell when they have a locked-in 30-year fixed rate mortgage of 4 to 3%? And if they were to sell, they have to deal with a 6 to 7% new mortgage rate, higher home price, so they have to pay 50% more monthly mortgage if they move up to a new home. So they are staying put. So the whole housing inventory is paralyzed. We are reaching a record low supply of inventory if all these negative numbers continue to trend downward. So when buyers don't want to buy because of lack of affordability, sellers don't want to sell, low demand plus the quote lock-in effect, unquote, of homeowners with ultra low mortgage rates staying put mean new listings will continue to decline year over year during the first half of 2023. However, if inflation persists, sales could drop by up to 27% year over year. But if inflation persists, that means interest rates will be elevated, and that causes people to continue to stay on the sidelines. Make sense? So prediction number 2, mortgage rates will decline, ending the year below 6%. What do you think? Please comment below on my video. So we expect, Redfin expect 30-year fixed rate mortgage to gradually decline to around 5.8% by the end of 2023. With the average 2023 rate sitting around 6.1%. I'll take it. I'll take a 6% interest rate. It'll most likely stabilize the market, I think. But if you can lower below 6%, then we are in good shape. Then we may see some real estate frenzy, if you will. I'm not going to say the word boom, mini boom, or real estate boom 2.0. I'm not going to go there yet. It's too soon. But the way it's trending in terms of lack of supply of inventory that we have seen throughout 2020, throughout 2022 this year, and then potentially 2023 and even beyond. So that we could have a another historic low supply of inventory. You know what I mean, right? Economics 101. What is economics 101? If supply is lower than demand, housing prices will increase. I say it again. If demand is greater than supply, housing prices will increase. What makes demand to increase? Not 6 to 7% interest rate, mortgage rate. It'll be below 6% mortgage rate to trigger higher demand. How much lower than 6%? Well, the lower the better. If it is at 5%, wow, watch out. We can see another post-pandemic real estate boom 2.0 in 2023, 2024, if the interest rate fall to 5%, which I don't think is going to happen. So I hope will be around 5.5 to 6%, my personal opinion. Then we may see a stabilized, balanced market. This is just my opinion. Okay, so anyway, and the Fed series of interest rate hikes should cause inflation to continue slowing, which is likely to bring mortgage rate down. How quickly inflation and rates come down depends on a number of factors, including the resilience of the job market. That's right. The employment rate will be very important to determine how bad is the housing market, how bad is the recession, and the psychology about what people are thinking. All right, and Redfin further stated that if inflation cools faster than expected and the job market moderates, rates may decline sooner and or more, dropping to 6% at the beginning of 2023, then settling at around 5.8 for the rest of 2023. But if inflation proves stubborn, rates are more likely to stay elevated, 6% to 7%, in my opinion, for several months and decline slowly before ending the year at just below 6%. So house hunters may need to have a higher credit score or lower debt-to-income ratio to qualify for mortgage as lenders tighten credit standards due to rising unemployment. Now, this is just a prediction. If unemployment stalling to escalate, well, we have seen the high-tech layoffs is happening recently. And, how I know, well, I live in the San Francisco area for the past more than 30 years, so I've been through the up and down cycle in California real estate market. So if the unemployment rate is higher, then the lenders getting loans, mortgage loans will be more difficult because the high risk nature of potential borrowers, right? So remain to be seen. So let me see what else. All right, prediction number 3. I had to go this faster. There's too many. There's more than 10 predictions. Okay, so I don't want to spend too much time on this video. Prediction number 3: home prices will post their first year-over-year decline in a decade, but the U.S. will avoid a wave of foreclosures. That's, I agree. Redfin expect the median home price to drop by roughly 4% since 2012, and because of the continued high interest rate. And so right now it's a lagging indicator. We're speaking right now in December. We're not going to see the November and December housing transaction data until January, February 2023. So there's a lagging indicator. So we're going to see, we expect new listings to continue to decline throughout most of next year, keeping inventory near historic lows. If inventory near historic lows of what like we have in 2020 and 2021, and if mortgage rate decrease below 5.5%, I predict we may have a housing buying frenzy, more demands, more people who can get off the sideline, and we may see multiple offers, bidding wars all over again. Right now, because sales and listings have decreased, trending downward throughout 2022 and inventory near historic lows. The only things that are preventing a housing frenzy is to 6 to 7% mortgage rate. That's the only reason. So the Federal Reserve, their rates volatility and what have you, up and down, will be a determining factor moving toward 2023 and beyond. All right, so let's finish up. If inflation remains stubborn, rates stay higher than expected, then oversupply increases more than expected, price could fall by double digits. I'm not saying all the markets because there are 400 MSA, there are 400 metropolitan statistical areas. There are more than 2,000 counties and there are more than 9,000 cities. So real estate is local, is hyper local as a matter of fact. So there's no such thing as a national real estate market. So you need to be very much aware of this. Not in the worst case scenario, not every area of the U.S. gonna fall by double digit in housing price downturn. If the worst case scenario were to happen. All right, so let me see what else. Okay, foreclosure next year is highly unlikely because homeowners who bought their homes at least for a few years are locked into a historical low fixed rate mortgage, 3%, 4%, and they have massive amount of equities during the skyrocketing pandemic. So they are in good shape. They are not in a stressful situation. When there's no stress in the housing market, when people sitting on amazing low interest rate and they have massive amount of equity, they're not going to sell their home. They're not going to forced to sell under most circumstances. So more importantly, when the job market remains resilient, even if there's a recession, economists expect a mild recession with a small increase in unemployment. So it is unlikely that many homeowners will fall behind on their mortgage payment. I totally agree. Prediction number 4, Midwest, Northeast will hold up the best because Midwest, the prices are the Rust Belt. You know what I mean by Midwest, right? So Indiana, Ohio, upstate New York, Michigan, Missouri, Tennessee, Illinois. Those Midwest markets, they did not go through the pandemic boom, and so those markets are bound to do are poised to do very well. The Midwest. So this is an up and coming real estate region. Some of the Midwest cities, Illinois, Chicago, Milwaukee, Albany, New York, Baltimore, Elgin, Illinois, Rochester, New York, Pittsburgh, New Haven, the top 10 Midwest markets that are poised to do very well. But who knows? On the other end of the spectrum, we expect prices to fall most in pandemic migration hotspots like Austin, Boise, and Phoenix. Yes, the trophy markets, the up and down market, what have you, the exciting market we've been hearing lately, but expensive West Coast cities are also likely to see outsized price declines because of the stumbling tech stocks and the shift to remote work pushing so many people out of those markets. Yes, that's true. So, yep, the West Coast, East Coast, high price, expensive markets, and the trophy markets are more poised to potentially continue to lose value of homes at least sometime in 2023, if the interest rate and what have you are not changing. Prediction number 5, rents will fall and many Gen Zers and young millennials will continue renting indefinitely. Well, rents will fall, but this data, rents will fall means that the survey was done on apartment buildings, multi-units, not necessarily single-family home renting. So our investment methodology, the way I work in my business model is such that we help mom and pop investors to buy single family home residential investing and we continue to see rents rise in the market that we work in the South and Southeast and the Midwest. So this prediction number 5, rents will fall. No, I mean, it's only referred to apartment construction buildings and multi-units in major metro markets. Okay, they didn't do us. Redfin did not do enough of a survey. It all depends. It all depends on the local market, what category of renting you're talking about. But anyway, so few renters will become buyers. So because of the home affordability issues, many people will continue to rent. I would say that we have the greatest rental market in history moving forward. More people are renting now than ever before for the reasons I just stated. Okay, that's very, very clear. So people are waiting on the sideline, they can't afford, they have not enough good credit, they don't have enough down payment. The skyrocketing of the interest rate has caused people to not qualify to buy those medium price of homes nationwide. So people will continue to rent indefinitely. So if you want to become a landlord, if you are already a landlord, you will have plenty of opportunity to find the best renters. There are bidding war for from renters in many of the markets that we work in, which is in the South and Southeast and in the Midwest. Prediction number 6, builders will focus on multifamily rentals. Yes, they're not focusing on single-family homes. So any first-time home buyers that want to buy new construction single-family homes, we could have a lot of problems because many of the builders, not only they're not building enough single-family homes for the potential buyers, from the foreseeable future, they are any kind of new homes, single-family homes they're building, they are not entry level. Builders are building single-family homes that are $500K, $800K, $1 million range. They're not. There's no profit margin to build entry-level homes, $200,000, $300,000, $400,000 anymore. So first-time home buyers will continue to be priced out of the market because of lack of new construction inventory, etc. So builders not helping with the supplier inventory, and the homeowners not selling. So we can see a very historic low supply of inventory moving forward. So if the demand comes back, we may if the interest rate are come back down to the mid 5s, or then we may see another massive housing frenzy all over again, like we did in 2021. Prediction number 7, investor activity will bottom out in the spring, then rebound. Yes, that is true. Many of the mom and pop investors are sitting on the sideline because they're too scared, because they are not experienced. As a result, they don't know when to pull the trigger. They don't know how to analyze cash flow. They don't know where to buy. They are scared. But those are newer and smaller mom and pop investors. They just like most people out there are, they are fear-based, paralyzed by fear, and they just not experienced. So only sophisticated investors understand this market, and they will continue to pull the trigger. Likewise, myself personally. So there's never a wrong time to buy investment properties, as long as you know where to buy, what location, what kind of system you put in place, etc., etc. Okay, I think prediction number 8, Gen Zs will continue to rent in close to major metros. Prediction number 9, migration from one part of the country to another will ease from the pandemic boom, but they will continue to migrate, not as fast as they have been in this past year, but we will continue to see that. And not only that, retirees and remote workers who have a lot of flexibility are still seeking out more affordable areas to move to. And for Americans moving for affordability, places with no state income taxes, Sun Belt such as Florida, Texas, and Tennessee will be very attractive. And I totally agree. Prediction number 10, this is the last one. Insurance costs, rising disaster insurance costs will cause insurance premium to rise especially in the Florida coastal markets. But those people in Florida, especially those areas, even at the coastal Florida areas, are very, very desirable. Those areas are likely to become more concentrated with affluent all cash buyers. So wealthy investors, wealthy retirees, and wealthy primary home buyers, they are targeting coastal markets in Florida, especially because of the desirability, because the lifestyle, and who does not want to live in a beachfront type of atmosphere. Everybody wants that, but only people that can afford it can do so. All right, so that's pretty much I hit. I want to talk about just the top 10. That's all I want to talk about. These only. Anyway, so that's what's Redfin. So my takeaway is, my takeaway is there would not be a housing crash because low inventory, because most 40% of the homeowners have no mortgage, they are free and clear, and 90% of the homeowners that have a mortgage rate locked in 30-year fixed rate mortgage at 4% or below. So they are sitting pretty, they have an amazing mortgage, they're not going to walk away from at all. They have massive amount of equity. People who bought homes in the past few years, or not in the past 5 years, in the past 10 years, they have achieved massive amount of equity and wealth. So that is their retirement gold mine. They're not going to get rid of it unless the mortgage rate will come down to 5% or lower. They may sell, but otherwise they're not going to sell. They don't need to sell because they're sitting in a gold mine. Homeowners benefit, investors benefit because the investors can buy in all kind of environments because they have the down payment, they have the financial resources to do so. The only potential losers in this game of real estate is primary home buyers that can't afford to buy under the current environment, and people who are sitting on the sideline, they're scared to pull the trigger. I mean, you got to buy real estate and wait instead of wait to buy real estate. So anyway, that's my real estate housing forecast for 2023. Thank you so much for listening. I know these videos have taken way too long. There's so much data to cover. So if you see a lot of value in this video, please smash the like button and subscribe to my YouTube channel. And finally, submit your email to our newsletter database so you become a free member of our real estate investing club, so you can receive free real estate education and real-time real estate investing opportunities. Thank you so much. This is Siwen Yi. Thank you for listening, watching, and I'll see you on the next video very, very soon. Have a nice day. Bye-bye.